Hi fellow freedom builders, and welcome back to the channel. In today's video, I am starting the new series called the Option Library, where we're going to take option trading and cut it down into the smallest pieces so that we all can see how we can use options in our day-to-day investing and trading. Today we're going to have a look at what is an option, because there are some core concepts that we need to understand before we can take on a bit more advanced levels. So let's dive right into the computer and have a look at it. First of all, in today's example here, I am going to use Tesla. I'm going to use that all the way through, and I'm going to give you some prices, some that are just theoretical prices, but just to give you an example. One thing you should remember when we are talking about an option is that one contract covers 100 shares. So when we're talking about one option contract, you should always multiply the amounts by 100. So if you buy a call option for $5, it actually costs you $500. If you are selling an option and receiving $12 in premium, you are actually receiving $1,200. That is an important thing to remember. But let's have a look at the basics. When we're talking about options, we can either buy an option or we can sell an option. And there are two different sorts of options on this basic level. That is a call option and a put option. So when we're looking at normal stock trading, as you see here, we have a Tesla stock. If I buy the Tesla stock, I can hope for the stock to go up in price, or if I have shorted it, I can hope for the stock to go down in price. But it is quite two-dimensional. The price can only move in two directions, and if I'm long the stock, if I have bought it and the price goes up, I make money. If the stock goes down, I lose money. It's a bit more complex when we are talking about options. So let's take it. There are 4 different areas in this matrix. We can buy a call option, we can buy a put option, or we can sell a call option or sell a put option. So let's take the buy side first. So when I buy an option, I'm buying the right to do something, but not the obligation. So let's have a look at it. It's a lot easier than it sounds actually. As you can see here in the matrix, when I buy a call option, that is the area here, you have the right, but not the obligation to buy a stock at a certain price. So let's look at the chart and look at how that could look here. We have Tesla and it is around $625 here. And let's say that we are buying a call option. When we are buying a call option, we are buying the right to call the stock away from another investor at a certain price at a certain time out in the future. We should also remember that option contracts always have an expiration date. So it's not like I can buy a call option and then wait till forever before I can exercise it. It is often a month or 3 months or 6 months out in time. It could also just be a week. So there's an expiration date. We cannot not just wait forever for something to happen. So let's say that the price of Tesla is right now 625-ish here. And I'm buying a call option on Tesla at what is called a strike price of 680. That is the green line here, around 2 months out in time. What I'm doing here is that I am speculating. I'm hoping that Tesla will go up in price. The expiration date is around here. So I hope Tesla has gone up in price before we reach the expiration. Now, I have the right to do something here, but not the obligation. So let's have a look at what I have the right to do. So let's say that I'm right in my assumption and that Tesla goes up in price to 800 in 2 months. Then I have the right to buy the Tesla stock at 680, and I can go directly out into the market and sell it for 800 and pocket $120 in difference for each and every stock, meaning 12,000. To be able to do that, I have paid a price. Let's say the option cost me $12 times 100, meaning that I have bought this option for $1,200. But 2 months out in time, I can now pocket $12,000 because that I have bought the right to call the stock away at 680, but it's now at 800. So the difference between the 680 and the 800, that is mine to keep. But I paid out in front. So if the stock didn't go up, if it only went to 650 or maybe it went down, then I could just choose to do nothing because I only bought the right to do something, not the obligation. And that's a big difference. All right, let's have a look at the other side of the buy situation, and that is buying a put option. Now, in the call option scenario, I bought the right to call a stock away from someone at a certain price. And that was if I hoped the stock would go up. Now, in the case of a put option, I'm buying the right to put a stock in the hand of someone else at a given price. And I would normally do that if I expected the price to go down. So let's have a look again at the Tesla chart. There's a red line this time. The price is still around $625. And we are now buying a put option at a strike price of 560 2 months out in time. That means that if the Tesla stock drops, let's say it went to 400 and I owned the stock, I could actually use this as a hedge because I might want to keep on to the stock, hold on to the stock, but I just wanted to hedge myself because I thought it was going down. So in this instance, if the Tesla stock is going to 400, I can, in 2 months' time, I have the right to sell the stock at 560 to the one that sold me the put option. So I paid a premium to them and they said, no, I think the Tesla stock is going up, so I'll just keep the premium. But it turned out that the Tesla stock went to 400 and now they're losing big time. They received a little upfront from me in an option premium, but now they have to buy stocks from me at 560 that they can then sell in the market for 400. So they have lost the difference. That's $160 times 100. That is $16,000 they have lost here. So buying an option, call option gives me the right to buy a stock at a given price. Buying a put option gives me the right to put the stock away, to sell it at a given price. Call options, that is when I think or hope the market and the stock will go up. Put options is the opposite. That is when I think it will go down. Now that was the buy side of the option matrix here. Let's have a look at the sell side because that is also quite interesting. Here we go. On the sell side, we can sell a call option or we can sell a put option. Now when we sell something, we receive a premium. And that is actually what I do a lot. I sell something called covered calls or something called cash secured puts. I will get to that in a later video, but right now it's important to remember that when I sell an option, I no longer have the right. I now have the obligation. So remember before, when I bought a call option, I had the right to call a stock away from another investor. Now, if I had been selling the call option, I'm now the other investor. So now someone can come and claim the stock from me at a given price. Let's have a look at the chart, how that would look. Now, again, we are seeing the Tesla scenario here, and I might think that the Tesla stock, it will just wobble a bit around here, maybe go a bit down, but definitely not go above 680. Now, I now sell let's say I sell a 680 strike price, a call option here, because I'm saying it'll never reach that level within the next 2 months. So I'm receiving a premium here. Let's say I receive $1,200. That is mine to keep, nice cash straight into the account. But the danger here is that if the stock shoots up, if it shoots up here, they can now come and claim the stock. And they can say, we want it at 680, but I have to go out in the market and buy the stock, let's say for $800, and deliver it to them at the price of $680. So I'm losing money. And remember, a stock can sometimes go up massively. So let's say Tesla all of a sudden went to $1,000 and I had sold a call option at 680, I would lose $320 on each of the 100 stocks, meaning $32,000. But if the price stayed down here or went even a lot lower, I would just keep the premium. Let's say it was $12 for each stock. I would keep the $1,200 in my account. Nice income. What I'm actually doing normally, just to mention that, is I never sell naked options, as this is called. A naked option is where you have unlimited risk. Now, what I do is that if I own the Tesla stock, I might sell some call options on it, because if it went up massively in price, I could simply just give away the stocks I already owned and I wouldn't lose as much. I would lose some upside, but I wouldn't have to go out and buy very expensively in the market. But that is another story. We'll take that in another video. Now, on the other side, we can also sell a put option. And again, we are taking on an obligation here, not the right. We now have the obligation. So when I'm selling a put, let's say I think that Tesla is going to the moon, and I'm selling a put option down here at 562 months out in time. If the stock drops here like a rock, if it goes to 400, I'm now obligated to buy the stock from the other investor at $560, and I can only sell it in the market for 400. Again, I'm losing $16,000 here. The difference between the 400 and the 560, that is $160 times 100. So I'm losing $16,000. Again, Tesla could go a lot lower. In theory, it could go to zero, meaning I would lose a ton of money. Again, this is what is called naked option selling, meaning that you are not owning the stock. You don't have the money tied in your account. You simply just sell it to get some income. That is extremely dangerous in this way, but it can be very beneficial in a lot of ways. And again, I'll mention that in later videos. So all you need to remember from today's lesson is that you can buy and sell an option. There are call options and there are put options. When you buy an option, you're buying the right to do something. When you're selling an option, you all of a sudden have the obligation to buy or sell a stock at a given price. I know this can sound a bit confusing if it's the first time you hear it, but I will repeat it a ton of times and I'll tell you all of the different aspects you can use this for. You can combine these buying and selling options at different strikes and different time expirations, and you can make some very powerful strategies to make some good money, maybe on stocks you already own. But this is all for now. I'll let you digest this a bit, and we'll have a look in the next video of how we can see what stocks cost, what an expiration date is, what a strike price is. We'll take all the details there from what is called the option chain. So until next time, take care of yourself and your money out there, and I'll talk to you again soon. Bye for now.